It's another episode of The Trading Bell coming for you right here from the NSE floor. And today I'm talking to Jadiah Mwarania, who is the Managing Director for Kenya Reinsurance Company. And we're going to be delving into some of the factors surrounding the company as well as the insurance sector at large within the country. But before we get into this conversation, why don't we take a look at his profile? Mr. Jadiah Mwarania is the Managing Director of the Kenya Reinsurance Corporation Limited. He has worked with the corporation for over 25 years and was previously the General Manager, Reinsurance Operations and Acting Managing Director. He holds a Bachelor of Commerce and Master of Business Administration from the University of Nairobi. He is a Fellow of the Chartered Insurance Institute of London and the Insurance Institute of Kenya. He is currently pursuing a PhD in Strategic Management at the University of Nairobi. Mr. Mwarania is a chartered insurer of the Insurance Institute of London, the highest and most prestigious level of professional achievement with the institute, and a fellow of the Kenya Institute of Management. He is also a member of the Board of Directors of Industrial Development Bank, ZEPRE, and the Chairman Executive Committee of the Association of Kenya Reinsurers. He is a board member of the Insurance Training and Education Trust Board and member of the Finance and Development Board Committee of the College of Insurance of Kenya. Mr. Mwarania is a holder of the Order of Grand Warrior Award. All right, thank you so much for joining me on the show today.
Welcome.
Let's begin by the fact that Kenya Re has been around from 1971. It's been in operation, and that spans quite a significant amount of time. So how do you see the company today and how it's, come through all these years?
The company today is stronger than it has ever been. Yes, it is true. We started operations back in 1971. Actually, the formation was in 1970. At that time, for many years, the corporation was only basically receiving mandatory compulsory sessions from insurance companies in Kenya. The business model was basically to deal with Kenya as a country, but it has evolved greatly over the years. We are now covering the entire of Africa, Middle East and Asia, and we have expanded the spectrum of the key classes of business that we do. We have increased sophistication in terms of how we do it, and going forward we see ourselves even going beyond these markets, beyond these three continents, but we have taken the view that it is good to consolidate our energies into these three continents before trying to go global.
Okay, amazing. 3 continents is quite vast. So you also have maintained the B+ rating by AM Best. And how do you manage to ensure that despite you being operational in such different areas, in such diverse areas, that you are able to keep a handle on all the operations?
It's because, of course, there are departments which are specifically charged with the responsibility of doing specific things, some for underwriting, some for claims management, finance, and the other areas. We also have managers and portfolios which are split between these managers so that every manager is looking at a manageable and sizable portfolio, so to speak. But we also have a model where we are dealing with the intermediaries for purposes of getting in business. Of late, the last strategy we have adopted is to use regional offices, as a result of which we've set up a subsidiary in Zambia and another subsidiary in Ivory Coast.
Okay. All right. Let's talk a little bit about the numbers because, the net profit you posted for ending December 2018 was 2.27 billion. And this was about a 36.4% drop in profit compared to the previous year. So how are you seeing the sector looking right now? Because as of 2017, according to reports such as those from AIB Capital, insurance penetration was at like 2% for that financial year. So what are some of the things surrounding this particular dip that you noted end of last year?
The last year was a very tough year for most financial institutions, including ourselves. But the drop is explained by several factors, which I'll go to in a while. Before the 2.2 is a net profit. The gross before tax, before tax we had 3.3 billion, which was quite commendable, I would say. If you look at the way the market performed, a lot of the companies were actually much lower than that. Now, for us specifically, what happened is that there were factors kind of beyond our control. For example, we are the biggest investor in one of the companies, reinsurance companies, and we take in a share of their profit into our results because we treat them as an associate. out of a 20% stake in that particular company. So when their performance was not as expected, there was a drop of up to 76% in the profit, so that affected us. There was also the fact that generally speaking, there was an uplift in claims payment across the market. Quite a bit of catastrophes came in, and the claims went up, and that affected all the players in the industry. We had an asset that we had treated in the account as held for sale, which the auditors thought we should treat it, we should actually impair it because of issues surrounding the property. That also affected us. So we would say that the issues that came in is not purely out of performance, but out of things out of the control. And finally, there was also the fact that the investment market didn't perform as well. The Nairobi Securities Exchange knows this. We saw the indexes coming up. We saw interest rates were not up to what we expected. So that is what contributed to that kind of performance. But going forward, we believe that 2019 is going to be much better than 2018, and we're going to definitely do more than we did last year.
So a lot of extraneous circumstances affecting that particular figure. But as of 2019, how are you seeing the bounce back? What are some of the things you see differently now?
Like, for example, there will not be another impairment of an asset in 2019. We believe that our investment in the associate is going to perform better than it has done. We believe in our own strategic plans, and the targets we've set for ourselves are higher this year than they were last year. We've taken various measures in-house, including the scrutiny of claims to ensure that we are paying only genuine and not claims which are not supposed to be paid. So given the strategies we have adopted, and of course we are a lot more aggressive in terms of markets visits and trying to generate business from markets, the fact that also we are more careful and more selective in where we invest, we believe this will be a different year.
Okay, and speaking of the claims, there has been, it's been a problem that has developed over time, and it still stands that fraudulent claims eat away so much when it comes to insurance companies. So it's a time-old problem, but what do you think it needs to be done to curb it?
Yes, fraud is always there. It's always been there in claims. In fact, a sizable amount, quite over 30% or so, of claims which are paid probably could avoid being paid. I think it's a question of systems. For example, what we saw in medical, which is one class of business where rampant fraud appears to be prevalent, we saw the introduction of the smart card as actually drastically quite reduced. Biometric identification of persons who are going to the hospitals, systems in-house to check on the validity of those claims. For example, we have had some insurance companies actually having nurses or medical personnel in the offices just to check that the prescriptions match with the disease and match with the kind of costs that the drugs are being prescribed. So administrative measures to break down these barriers of collisions maybe between hospitals and pharmacies and insured are some of the things that can be used to reduce the claims incidences.
Okay, and even as we talk about some of the more streamlining of such things, there's always this digital move that a lot of sectors are going through, including digital insurance. And where do you see that going, especially when it comes to the Kenyan context?
It is inevitable. The technology is actually driving business now. If you're going to do this business not on platforms on technology, then certainly you'll not get it right. We are seeing very discerning insurance and customers, much more educated. They're using websites to search for products, to review the processes, to make their own demands and comments of the service they are receiving. We are seeing claims actually being continuously or more increasingly being handled on platforms that are web-based. So really technology is driving the process. When it comes to customer service and turnaround times, if you don't have a sophisticated system that can pick out the issues and respond quickly, I think you'll be left behind. Yeah.
Okay, and moving away from that, Kenya Re is majority owned by the Treasury, as we were discussing a bit earlier. So recently, the Treasury has taken on a lot of loans. Recently, the 75 billion shillings from the World Bank was approved. You have the Eurobond, and just from an insurance perspective, what is the sustainability of that repayment of this debt that we keep on incurring?
It is true, Kenya Reinsurance Corporation is owed 60% by the government, which is the biggest stakeholder. But unlike many other public entities, Kenya Re always pays dividends to the government. It does not look up to government for financial support, at least as of now.
Okay.
And that is because we run it as a business. We run it because it is in a private sector kind of market. We have to compete with private sector companies, actually some of the biggest in the world. So we try to operate as commercially as possible and with all the ethics of a private sector operator. So for that reason, we've always been able to pay dividends. We believe we will continue paying dividends, substantial amount of dividends actually. So the issue of the national debt may not directly affect the corporation. In terms of sustainability, I think in economic planning, it all depends on budgeting. It depends on what the money, how the money is used. If the money is taken and used properly for purposes of national development and in projects that are going to repay back, then it is okay. Because we've seen a lot of countries across the world actually have quite a high debt burden, but management of it and how it is used and the repayment structures and how it keeps on being restructured is really where the issue is.
So the make or break is, of course, the way it's used.
The way it is utilized, yes.
Okay, let's talk a little bit about some of your expansion plans, such as the ones you have coming up for Uganda.
Yes, like I said, the model to expand away from Kenya and into the region, which we have been consistently doing, we also realize that you need to give quality service to those countries. It might be difficult to give quality service to 54 African countries, for example, from Nairobi. So it is necessary to go nearer the seeding companies or the insurance companies to make sure that the service is good in terms of underwriting, the aggressiveness in terms of seeking for business is there, the payment of claims is done on time, turnaround time in everything. So what we've so far done is that we've set us a subsidiary company in Zambia, in Lusaka, Zambia, that is meant to serve the Southern African countries. We're talking about Namibia, South Africa, and all the countries down there. Then we've set up another subsidiary in Cote d'Ivoire, and again that is meant to serve the Sika region as well as many of the countries in the Francophone. Now Uganda, we are also setting up. We actually hope that the shareholders are going to support the proposal by the corporation in the upcoming AGM in June. And if that happens, we are going to set up in Uganda because Uganda as an insurance market has domesticated. Only reinsurers who are based in Uganda can do business there. So if we don't enter that market, what is going to happen is that we will lose out in the business that we have in Uganda. We've built it over very many years. It is quite substantial. It is a key market to us. So we believe it's a good move to set up there for purposes of preserving the business there as well as growing it.
Okay. And as we wrap up, something that you'd like to tell your shareholders from this point on?
From this point on, what we would say is that Kenya Re, the management, the board, and always works with the interest of the shareholders in mind. We always work knowing that those shareholders invested in the corporation. We have tried every year to pay dividends. We'll do it even this year, and going forward in our projections, we've actually factored in payment of dividends every year. And it is only in their interest that we actually serve the company. If you look at the financial performance, all the way from 1970 and specifically from 2010 going up, there has been growth every year in terms of the gross written premiums, in terms of the investment incomes, and in terms of profitability, except for last year for the reasons I've explained. In fact, one of the pieces of information I picked in the media not long ago about Kenya Re having collapsed is actually quite erroneous. Kenya Re has never collapsed. It has even never come anywhere near collapse. Maybe it's a mistaken for another institution. We've never come anywhere near there. The company has performed very well. If you look at all the fundamentals, the capital, the profitability, the written premiums, the investment income, everything has been a growth trajectory, including shareholders' funds.
All right, thank you for clarifying that as well for us and for joining us on the show today.
Thank you very much.
Well, from that conversation on insurance, onto our market analysis. Well, the markets have closed and we want to take a look at some of the highlights from the numbers this week compared to last, as well as, of course, break down the most pertinent issues when it came to the budget reading 2019-2020 that took place yesterday. Joining me is Mercilin Gatebi from Kingdom Securities to help us analyze all of this. Thank you for joining us, Mercilin.
Thank you.
Okay, so let's get first into our numbers from the markets this week compared to last. What stood out to you the most?
Looking at how the market has been trending for the past 1 week, we have noticed actually a lot of net foreign inflows. We have had a lot of foreign interest coming into the market, and this has mainly triggered a lot of activity on the banking stocks. If you look at the top movers for the week, we have banks like NIC, we have banks like KCB, Equity and Cooperative Bank, which have actually been trending on the top movers. So I think there's a lot of interest building up in the markets, especially now with the prices which are there, which are quite good, quite attractive entry points for these foreign investors, and also for the local investors who are actually scouting the market for good opportunities.
That's very interesting, because actually something else that stood out from the budget reading was the proposal to repeal the rate cap when it comes to the banks. And of course, it will still go through its processes. But from CS Henry Rotich, what he said was that they have proposed the repealing of the rate cap. What do you think this means for the banks, and how do you see this playing out?
I think this is something that the banks have really waited for a long time, because
Yes.
looking at profitability for the banks in the first years when the interest rate controls came in, I think the banks were really hit. But now it will be good news for the banks, because now it means that they can actually price the risk of their customers. Some of the disadvantaged groups from lending have actually been the SMEs, and now with the repeal of the interest rate cap, it means that now SMEs can actually access credit from the banks. So basically what we expected to see is a shift now from the credit to government to credit to the private sector, as banks now resume their lending to the private sector.
Absolutely. I think one of the biggest losers of that entire scenario with the rate cap were the SMEs, because they were not willing to lend to them due to the risk, and they were mostly lending to larger corporates.
Yes.
So it's definitely a relief, I think, for a lot of people. But do you expect the banks to take undue advantage of this and really hike up the rates?
Well, not necessarily, because I think there's also competition coming in from other financial institutions. We have microfinance institutions, we have SACCOs, which are actually advancing credit to the market, to the SMEs and also to the retail market. We also have mobile lending platforms. We already have a new product, the Stawi, which is it's an initiative of the government and a few banks. So basically, I don't expect that to actually cause some kind of rip-off from the banks to their customers. I don't expect a rip-off from the banks.
Okay.
Yeah.
All right, we'll see how that plays out. But still, actually, on the conversation of banks, we have, of course, seen with the new bank notes, they're going to be discontinuing or demonetizing the 1,000 shilling note by October 1st. You have to go and exchange it within the system if you're holding any by the deadline. So how do you see that affecting the economy? Because what they're trying to do is, of course, stifle a lot of the money that was in hiding, that wasn't really in the system.
The good thing with the demonetization process is that we get to clean up the any proceeds which actually came into the market illegally, like for example corruption, terrorism, and all the like. So for us as analysts, what we feel about the demonetization process and what is going to happen is that there is a chance of there being some level of high money supply in the market. But again, this is actually being done in a very gradual process. So you might not feel the impact of high money supply at one go, because now with money supply going up, you expect also the inflation to actually come down. But of course, now that one is going to be well managed, and like other economies like India, which have gone through the demonetization process, but for a shorter period of time. This one is actually going to take a longer period of time. So we don't expect it to actually have a very significant impact to the economy. But then again, we have already seen as much as we are cleaning the corruption proceeds, there is new now fake notes coming in because
Yes.
people don't yet understand these notes. They don't know how to differentiate between a fake note and a genuine note.
True.
So of course, it's opportunities for people to actually take advantage of the people of the or rather to take advantage of the citizens. Yeah.
Okay. All right. And let's look at some of the other issues that actually came up within the budget reading that were very pertinent. The sin tax has gone up by 15%. So that's basically on things like alcohol and tobacco. And do you see that the 5 billion that the government now aims to collect from that particular line of thought is going to play out significantly?
In terms of the tax measures that the government is trying to apply, let's first understand that they're actually targeting a market which is already taxable. We have not yet reached out to the untaxable, which it forms the larger group of people. So we are basically just trying to put more punishment on people who already are giving in their taxes. Yeah, it's a good thing because with the 5 billion, it's money that maybe the government didn't have and they're expecting to actually gain from it. Again, I think this does not in any way affect consumer preferences because like for whatever they are targeting, these are commodities which will always have some kind of interest from the consumers. So that will not in any way affect the consumer preferences even if the prices go up. On a scale of 1 to 10, I think what the government is doing with the excise duties, I'll give it a 3 because what they're trying to do is just to close on a very small gap, yet the gap which is already there is quite wide.
Okay.
Yeah.
And already we know that Kerry has had some challenges, especially in the past 4 years, trying to meet that target. So just setting the benchmark even higher at this point may not be the most effective thing in the long run.
Sure.
We'll see how that works out as well. But let's talk about the budget deficit because as of this reading, it's at about 5.6%, and that's like 6 to 7 billion. And we have been told that it has come down from the previous budget. However, it's still significant. We're still going to take on a lot of external financing. We're still going to take a lot of domestic debt to meet that about 607 billion shilling deficit in this year's budget.
Yeah, Ronia, I don't think we expect to really bridge the gap on the deficit with the revenue collections that we're actually having. Every year we are growing the budget deficit, I think in absolute numbers, but in terms of the deficit against the GDP, of course that number is coming down. But if you ask me, I think now as we're getting into this new fiscal year, we expect not to just continue the government to continue having a high appetite for domestic debt. External financing is also going to be significant. We don't expect them to really go out to the external market for a new Euro bond, but of course in terms of commercial financing, that is going to be significant for them. And especially now that we have been rolling over debt, we have a lot of maturities coming up in the near future, both in the domestic markets and also in the external market. So we expect a lot of activity in the domestic market and the external market, but also in terms of the revenue collections, I think there's a higher chance that they may not actually meet the revenue target that they have set for this year as compared even to the previous years.
So the revenue expenditure is actually at about 2.1 trillion and the expected is at 2.8. So clearly there's already that discrepancy there. But like you say, there's rollover happening. So you don't think the debt issue is unsustainable?
Well, at the moment, I mean, going by whatever we have, the debt levels could be unsustainable because basically what we are saying is a lot of these expenditure is actually going to recurrent, not even the development. We have had a very low absorption of the development funds in the economy. And if at all you're not going to actually have higher funds, or rather a higher amount of funds going to development, then how else are we going to actually pay off the debt? Because we would expect that you will inject in capital for you to have a return to be able to actually meet the debt repayments. But what is happening right now, we are raising more debt so that we can actually meet the current expenditure. So of course the debt levels are becoming unsustainable as we get along.
Yes.
Yeah.
All right. It's almost a catch situation.
Exactly.
All right. Well, thank you, Mercy-Lynn, for breaking down a lot of the major things that came up during the budget reading this year around. But before we go ahead with some of our other segments, let's take a look at Markets 101. Top of the funnel. This refers to the very first stage of the buying process. Leads at this stage are just identifying a problem that they have and are looking for more information. All right, let's take a look at some of the questions that have come in from you. And the one we decided to answer today is on the budget reading. And the question was, what exactly is capital gains tax? It's gone up from 5 to 12%. But what does that even mean? So Marcelin, do break that down for us.
Thank you. Just to break down for us is that capital gains tax is basically a tax which is charged on any land proceeds when you're actually making a sale of an asset. But in this case, we're actually talking of land. So any proceeds that you get in terms of capital gains, that is what is actually taxable. And the tax that is actually now being in place is actually going to be 12.5% and not 5% as before. So that has actually gone up. And this, I think, will be a lot of interest, mainly for the foreign investors and also for the local investors who have actually invested in land assets or in real assets in Kenya.
Well, of course, history plays a big role in how things end up in the present. So let's take a look at the NSE historical fact. In 2016, the NSE joined the United Nations Global Compact, the world's largest corporate sustainability initiative. It is committed to supporting and embracing a set of core values in the areas of human rights, labor standards, the environment, and anti-corruption. Thank you for joining us and for breaking down so much for us this week.
Thank you so much for hosting me.
Great. On that note, let's wrap it up. This has been another exciting episode of The Trading Bell. Thank you for joining us. And of course, we will keep on keeping you updated through our social media handles that are appearing on your screen right now. Stay up to date with The Trading Bell all over social media with those particular handles. I'm Maalika, Kazia, and this is The Trading Bell.